You want to define your investing strategy. Are you buying and holding, right? What is your exit strategy out of hard money? Make sure that you know how to get out of a hard money loan before you ever get in one, right? Are you going to qualify with a portfolio bank? Are you going to go with a conventional mortgage? Do you qualify for a conventional mortgage? Understand how to get out of it. If you're flipping, you want to keep your product as good or better quality finish out than the comparables in the target market or in the market that you're in. Don't overprice. One thing here, do not overprice your house to make up for rehab overage, all right? First, understand most rehabs go a little bit over budget. I recommend setting aside 10% of the total costs at the bottom of the rehab estimator, 10% of your total costs additionally for overage. Most rehabs go over budget, okay? Don't try to make it up by listing your price aggressively or higher to try to recoup that. Price it competitively in the market to sell it fast so you can get paid and go on to the next deal. Try to stick to your best exit strategy, okay? So if you're buying to flip at a $400,000 price point, it's not a very good idea to try to change the exit strategy into a rental, right? Because your rental is probably not going to cash flow, depending on what market you're in. 400,000 in Texas, your rental probably is not going to cash flow with a mortgage that high. Also, if you're going to do a rental property and you're doing a rental grade finish, don't think that you're going to sell that retail if you have to by changing your exit strategy midway through or at the very end if you're not able to sell it. See the process through. Understand it up front. Don't change your plan. See it through and learn from any mishaps that come along the way. Many of the bad outcomes that have happened on deals have came from people changing their exit strategy midway through or after buying the property and then changing their intention of what they're going to do with it on the backside. So try to stick to your plan. If you do have to switch your exit strategy, okay, sometimes you just have to. Sometimes a property won't sell, or for other reasons you've got to liquidate it, you've got to do something with it. If you have to switch your exit strategy, I strongly encourage you to stay within 20% of the median home price in your area. All right, what that means, say that the median home price in the area is $250,000. 20% of that is $50,000. You want to stay and keep your buying criteria within $200,000 to $300,000. Why? Because you have the most potential buyers in that price range. Okay, the biggest pool of potential buyers are going to be plus or minus that median home price. 1. 2, you have multiple exit strategies that would still make sense. All right, at that price point, you could wholesale it. Right? You could dump it if you had to and take a smaller loss because you're not in the $600,000, $700,000 price range where your holding costs are through the roof. If you have to cut your losses, you can just cut it and get out. 3, you can just sell it as is. You can sell it list it to somebody, a handyman type that's coming in that wants something. They can, do sweat equity and improve it and, buy it as a homestead and do it that way. 4, you can rent it out in that price range. Rentals are probably still cash flow or at least break even. So you have a potential of renting it out. You can also rent it and sell it as a turnkey rental. Most people like rentals in that kind of price range. So you have an option to sell it as a turnkey rental to other investors once the rehab is finished, stabilized, and you can move on that way. Lastly, you can owner finance it, right? It may be a little bit high on the price point, but again, at least it's a potential exit strategy that you have by sticking to 20% plus or minus of the median home price in your area. That's the best way to switch your exit strategy if you have to, by making sure up front that you stay within that buying criteria. So let's jump back into defining your investing strategy, okay? Buy and hold, what you want to do to go forward with this strategy. You want to make sure you can get out of hard money before you ever get in it. That's very important. That's extremely important to us. We've done nearly 500 loans and we've only had to take back 1 in the life cycle of our business, right? We really take pride in setting people up for success so they can get out of their deal before they ever get in it. You want to understand the conventional loan requirements. That is the best loan product that you can get for buying and holding, because you can get the best rate, the best terms, and just overall the best product that you can get for buying and holding single family rentals. You want to also understand portfolio and commercial loan products. If you're past that Fannie Mae 10 loan limit, then you've got to go to portfolio or portfolio or commercial loan products. You can find those with local banks, credit unions, things of that nature. Ask other investors that are experienced, right? They're beyond that 10 loan limit, or maybe never even went that approach because they don't have the qualifiable income or other things that you have to qualify with conventional loans. It's the strictest loan requirements. Also, there's a lot of national refi programs that are out there now, and they've gotten very competitive. And for people that are in a situation that can't qualify for conventional mortgages, I think this is a fantastic option as they have progressed over the past couple of years to be able to buy rental properties if you don't conform to conventional loan requirements. Flipping strategy. So if you want to proceed with this investment strategy, flipping, then make sure that you know your target market and your price point. Like I said before, preferably stay within 20% of the median home price, because you have the most amount of exits. You have the biggest potential buyer pool and the most amount of potential exits if your primary strategy falls through. You also have to take in consideration your cash in the bank. Do you have enough money to float the holding costs for the life of the loan until you sell it? Do you have additional money for repairs set aside? Because like I said before, most rehabs go over budget. Also, do you have money to come up for inspection request items that come up during the sales process, like a new roof, right? Maybe there's a hailstorm that comes through when your property is listed or you're still rehabbing it, and you've got to go through that process and put a new roof on it, get reimbursed by the insurance company. Do you have money to float that? Do you have money to float your interest payments for 6 to 12 months? Just to make sure that you're safe. Again, make sure you can get out of the deal before you get in it. Make sure you have proper liquidity. You need to understand leveraging other people's money, private money and hard money, in addition to buying cash. Some situations you're going to need to buy cash or want to buy cash, and in some situations you're going to want to use hard money or private money to be able to leverage and buy more properties, right? Keep your cash for the deals that you really need them. Have it set aside if you have that amount of liquidity. Use private money or hard money to do 2 or 3 deals, knowing that you have a good nest egg set aside of cash that you can tap into if and when you need it. Lastly, understand the rehab strategies. Like I went through in Know Your Numbers, Hard Money 306, know the rehab costs and the strategy that you're going to use to get through the project. Are you going to hire a GC and trade time for money? Are you going to do the work yourself, DIY it, and do the best product, the best quality, and sacrifice the time? Or are you going to sub out everything, potentially save yourself 20% of a GC fee or cost yourself an additional 20%? You need to know that going into it so you can properly define your exit. Here's a brief look at conventional loan requirements, okay? I'm not a conventional lender, but I would recommend talking to one. If you need any referrals, please contact me. I'll gladly share. Here's a brief breakdown that I've gone through for you using my previous experience. I've used probably about a dozen different conventional lenders in my investing career, so I could understand the loan products, the speed, the fees, the ins and outs of what conventional lenders offer. Some people have different overlays. Some people can only do 4 loan limits versus 10. It's best to try to find your conventional lender by asking around, again, networking, talking to people, so you can figure out the best conventional loan product that works for you in your situation. Conventional loans are 30 years fixed. Again, best rate and term that you can get. They're up to 75% LTV. In some cases, you can get 80%. It'll be your rate and your pricing will be a little bit more expensive. I don't recommend that, but you can go up to 80%. Currently, excellent borrowers, you can get rates in the mid-5s. Rates are rising. This is as of October 2018. You need 2 years of qualifiable income. Sometimes you can get through with a Freddie Mac product for 1 year qualifiable income. No bankruptcy within 2 to 4 years. No foreclosures in the last 7 years. They can't lend to LLCs, so it's got to be to you individually. If you don't like the risk tolerance of that, of taking on properties in your personal name versus a company for liability and asset protection. You got to factor that in. They have stricter underwriting criteria. There's a 10 loan limit for Fannie Mae. Some additional banks may have additional overlays that limit that to 4 or 6 or 7 or sometimes 2 or 3 or a loan collective loan amount. You need to understand that question up front as well. I want to point out 2 awesome benefits of buying using hard money and then refinancing into conventional. Okay, so you need to buy a house that needs a lot of work, or you have to close quick, and then you refinance into a conventional loan product knowing that you qualify ahead of time to get out of the hard money loan before you get in it. So you can buy up to 4 houses at once with a hard money lender, fix them up, stabilize them, get them rented, and refinance all 4 at the same time using a conventional lender. This is a way to quickly, rapidly build wealth and passive income, minimizing time if you have the capital set aside to do so. You can get aggressive, buy a bunch of houses, one with the experience, knowing the rehab process, using a trusted lender, and then refinance out buying 4 houses at a time. So you do it once, buy 4, do it again, that's 8. Then you can buy a couple more, and you've reached your 10 loan limit for Fannie Freddie loans. You switch over into a portfolio or commercial loan product at that point. Secondly, there are no seasoning requirements going from hard money to conventional. What that means, if you're to buy something cash and you want to refinance or take cash out, then you have to wait 6 months seasoning on that property, property to be able to refinance and take cash out. A hard money loan is built so that you can do a rate term refinance, not a cash out, rate term. All you're doing is refinancing the underlying mortgage. Do a rate term refinance straight into conventional in as little as a month. Again, no seasoning requirements. We've done loans where people need to buy really quick. It's a fantastic deal, but they've got to close in a week. So they come to us, we close the loan, no work is needed, right? You use hard money when a lot of work is needed, or you need to close quick. In this example, they need to close quick. They've got a heck of a deal, no work needed, so they come to us, we provide the funding, they get the property, and then instantly turn and refinance that same asset in less than a month. Typically it takes about 30, 45 days for the conventional loan process, and they can go ahead and refinance without ever making a hard money loan interest payment. And with going with a rate term refinance, you get a better rate, slightly better rate, and slightly better pricing, because it's less risky to refinance something you already own versus taking cash out of a property or buying something new that you didn't have before. So you can save on your pricing and get a slightly better rate for the life of however long you want to hold that property. Next, I want to go into portfolio and commercial loans briefly. So these vary considerably depending on your market, depending on your bankability, depending on your banking relationship. But in general, up to 80% LTVs, usually based on prime or LIBOR. You can get 3, 5, 7-year terms. You get AMs of 10, 15, 20, sometimes maybe longer. There's fixed and adjustable, a lot of options. But really talk to experienced investors that know what these products are, because if they've been in the industry for a while, then they've had to utilize this type of loan product, and it could be advantageous to talk to them about that. Next, the national refi programs. These programs have improved significantly over the past couple of years. I've done loans as a broker to some of these national lenders where we're locking people in the 6s for a 30-year fixed loan. Comparing this to a commercial or portfolio loan, right? The AM on those is typically going to be about 20 years. So even though you're paying a little bit higher rate, but with interest rates going up lately, I would say these are not too far off, depending on the criteria of the asset that you have, right? They're going to consider DSCR, LTV, credit score, loan size, loan type, right? A purchase versus a cash out or a refi. And you can get rates as low as the mid-6s currently using a 30-year fixed loan product. at about the same rates, you can get a 20-year AM. So your cash flow, your payment goes down considerably, and your cash flow per property goes up quite a bit. Keep in mind, a lot of these loan products have a prepayment penalty, 5, 4, 3, 2, 1, which means you pay 5 points in 1 year, 4 in 2, 3 in 3, 2 in 4, and 1 in 5 years to refinance or sell that property. There's a prepayment penalty. And know that they're a little bit more expensive up front, right? They're gonna have higher points. To be able to get that low rate, you're gonna have more expensive points, doc prep fees, underwriting fees, you know, and the prepayment penalty that I mentioned before. There are also no doc or low doc lenders. And be cautious with your intentions using the national refi programs, right? Because they market non-prime loans, which are the new subprime loans, right? You want to make sure that you have the fiscal capacity to absorb a market correction or a downturn where maybe rental prices go down, your rate's going to stay fixed, and if you're not cash flowing anymore, you want to make sure that you can absorb that little hiccup, make it through the market cycle, and pick it up on the back end. You don't want to be in a bunch of subprime loans, because we all know what happened last time that became a national phenomenon. That concludes Hard Money 307, Know Your Exit. This is Chris Jameson, SF Lending, your hard money lender for life.